So welcome to today's webinar on Is Your Business Insurance Adequate? I'll be your presenter today, Tim Ward, and I'm the Financial Advisor here at FWO Chartered Accountants. So it's a very interesting topic that we'll be covering off on today, and I've received a lot of feedback around today's topic, so we'll jump straight in and start the presentation. So with business succession planning, we'll be covering off today the types of business exits, the tax structuring and the ownership issues involved with ensuring that the business insurance is set up in the correct structures. So we'll start off with some of your typical business exits, and we're starting off with, so we've got administration or liquidation. We've also got, there can be a business sale, so that can happen with third parties. There's also whereby a business is growing, you may have the introduction of new business partners coming into the practice, and you can also have management buyouts, retirement and partner buyouts. We see that quite often. And also you have sacking or compulsory buyouts, and lastly involuntary sale and buyout, whereby a death or permanent disability has been suffered by one of the business owners. So just looking briefly at the typical legal structures that a lot of practices and businesses have. Firstly, we've got partnerships. So partnerships are whereby the assets are held between their partners, either as individuals, trusts, or companies. So most people are quite familiar with how a partnership works. We've also got companies, so you can have the shares held by an individual, shares held by a spouse of a director, or shares held by a family trust. So and the last legal structure there with trust. So the legal relationship between the trustee and beneficiary exists in that structure, and it cannot exist without trust property. So protection of your business, and business protection specifically, has three key needs for a business. So firstly, you have what is called asset protection. Then you also have revenue protection and ownership protection. So we're just going to look at these in a bit more detail, each of these three levels of protection for a business. So with asset protection, so the most important asset to a business is not the obvious physical assets, but the key person or persons. So in the event of a key person's death or disablement, a business may be forced to sell the assets to maintain cash flow. So asset protection helps here because it can provide you with enough cash to preserve its asset base so it can repay debts, free up cash flow, and maintain its credit standing if a business owner or loan guarantor dies or becomes disabled. So it can also release personal guarantees secured by a business owner's assets. Typically, the family home is used as a guarantor there. Next, we have revenue protection. So a drop in revenue is often inevitable when a key person is no longer working in the business. Losses may also result, and while finding and training a suitable replacement from demand that can't be met, errors of judgment by a less experienced replacement, or reduced morale of employees. So there's a range of issues that affect a business when a key person is not working in the business. And if there isn't a suitable replacement within the business, it may be a costly process and takes substantial time and financial inducement to find a suitable successor or train a suitable successor. So it can be quite an arduous task to do that. So with revenue protection, it can provide your business with cash to compensate for the loss of revenue and the cost of replacing a key employee or a business owner should they die or become disabled. So quite a critical area to protect with your business. The ownership protection. So the death of a business owner can result in the demise of an otherwise successful business simply because of a lack of succession planning. So while business owners are alive, they may be able to negotiate a buyout amongst themselves, for example, an owner's retirement. But what if one of the business owners dies? So we're just going to have a look at the ownership protection in this scenario. So the remaining business owners must now negotiate with the deceased owner's legal representative, who may be more concerned about the needs of the estate than the business. Many business owners mistakenly believe that this contingency has been catered for in their business constitutional documentation, but often there is no buyout provision, or if there is, it's often ineffectually drawn up and inadequately funded, pardon me. So there's significant risks there in the event of a business owner dying. So, and similar issues arise when an owner is disabled and cannot be involved in the business, whereby someone may be total and permanently disabled and no longer to work ever again. So the same principle applies there. So what is ownership protection? So ownership protection can provide the continuing owners or their nominees with sufficient cash for the transfer of the outgoing owner's equity to the continuing owners should a business owner die or become disabled or even suffer a critical illness, for example, cancer. So one of the most important considerations with business insurance is to ensure that you have the tax structuring spot on, because it's an extremely important consideration in regards to this for business insurance. So getting the right structure in place is crucial. It's all about getting the right amount of money to the right people at the right time. So getting the right amount of money, so getting fair value for your business in the event you die or become disabled, to the right people, so ensuring that it goes to the surviving business owners and at the right time. So wanting to really lock in that in the event that you suffer as a business owner a death or disability, that the business can continue without a huge hit from either a revenue perspective or the ongoing practicalities of running the business. So with regards to the structuring, typically with a buy-sell agreement, and this will be funded via an insurance policy, and there are typically three main types of policy ownership for that. So we have self-ownership, cross-ownership, and trust ownership, and each of them have varying taxation issues related to how they are implemented and in effect when that comes about. So with a self-ownership model, it's as the name suggests, the policy will be owned by the life insured, so they also are the beneficial owner. And so this is where insurance is paid to the business owner, and if they are deceased, the insurance is paid to the business owner's estate. A buy-sell agreement deals with the transfer of that partner's interest in the business in exchange for the proceeds received. So the recipient of the insurance proceeds may be different from the business owner, depending on the scenario. The payment of the life insurance proceeds is not money or property provided in exchange for the sale of the business, but a consequence of the insurance contract itself on death. So we can see here that with this type of structure, the policy is paid out to the life insured's estate, and the buy-sell agreement oversees the payment between the vendor and the surviving owner. Next, we have cross-ownership model. Don't typically see this model used a great deal, whereby it's typically used where there's two business owners, and it's quite a simple business structure. So under this cross-ownership model, if a partner in a business suffers a trauma event or dies, then the insurance is paid to the surviving partners. The difficulty with owning insurance in a cross-ownership model is that the way that it is, it's difficult to remove or add partners to the business and to this insurance arrangement. So that is, the insurance arrangement needs to be restructured every time there is a change in the partnership. So as you can appreciate, this adds a extra level of complexity and administration every time a new business owner either enters the business or ceases to be part of the business. Next, we've got the trust ownership model. Now, this has been quite a popular method of ownership in recent times, and the way in which it works, each partner of the business separately takes out an insurance policy that will be held in a specifically set up trust. That is, if a partner suffers a triggering event, then the insurance proceeds are paid to the trust. Then the trustees can either be family members of the person who suffers the triggering event, or the remaining partners of the business. The trustees will receive the insurance proceeds and pay the same to the beneficial owner of the policy. The difficulty here is that in the hands of third parties, trauma insurance and sometimes total and permanent disability may be subject to capital gains tax, may be subject to capital gains tax. The taxation issues such as CGT and income tax make it worthwhile getting proper structured advice from your accountant and lawyer. However, when structured correctly, no negative tax consequences will be generated by a business using a trust to hold insurance to fund a buy-sell agreement. So this is a very good ownership structure, and when done correctly, can maximise the benefits to the business owners in the event of a triggering event. Next, I just wanted to highlight in this busy table some of the different income and CGT liabilities that do exist depending on the ownership structure of the relevant insurances. So down here on the left-hand side, we have the different insurance policies with life, TPD, trauma, and income protection down the bottom. And up the top here, we've got the different ownerships. We can have a self-owned policy. We can also have policies owned by another person, not the employer, for example, the spouse. And also we have two different business owners, being it for a revenue purpose or for a capital purpose. And lastly, we also can have policies owned by the super fund. And this adds an extra level of complexity, given that super funds have a different tax system, if you like, and treatment of proceeds paid to them. So for today's purposes, I've left super funds out of today's webinar, purely because I could spend a whole webinar talking about the tax consequences within ownership of having proceeds paid by the super fund. So we'll leave a lot of that out of today. and just wanted to talk about, so from the self-owned to a spouse, effectively, key person revenue to the business, and key person capital for capital purposes. So from a CGT perspective, we can see from a self-owned perspective, CGT is not payable. So this is a pretty good structure for taking out those covers if that's appropriate for that business scenario. The only time whereby we do get can have some issues is whereby a TPD policy is paid for capital purposes. So this needs to be looked at in the event of structuring a policy and ensuring the right structure for ownership is taken out for that. So I just wanted to highlight with a pretty simple case study today of what can go wrong. So Alex and Bill each own 50% of shares in a successful engineering business when Bill died suddenly. So Bill's shares are inherited by his wife Lynn via his will, and because there was no buy-sell agreement in place, Lynn is actually not obliged to sell the shares to Alex, and Alex is not obliged to buy the shares from Lynn. Furthermore, there was no agreed price or time frame for the transfer of Bill's shares, and there was no insurance in place to enable Alex to buy the shares. Alex does not have enough funds to buy out Lynn and does not have the capacity to borrow the money. So to further complicate matters, Lynn is entitled to the same management rights and share of profits as her deceased husband, while Alex is doing 100% of the work and is receiving 50% of the profits. So this creates a huge problem, particularly for Alex, in that he's continuing on work in the business at his capacity and only receiving 50% of the profits generated by the business. So this outcome could have been avoided if Bill and Alex had executed a buy-sell agreement and funded that via a life insurance policy. And this would alleviate any of those issues surrounding what has gone wrong here. So it's a very clear and simple example of what can go wrong in the event that no plan has been put in place, and specifically it hasn't been executed correctly. So just wanted to highlight some of the outcomes with addressing succession needs of your business. It provides you with peace of mind knowing that your business will continue in the event of death and or disability, and that you and your estate will receive a fair value for your business, which you have built and put your hard work into. So just concluding today, it's been a short webinar to cover off today's topic, and today's offer is just to offer a free consultation regarding any business succession planning or insurance planning needs that you may have. It's open to the first 10 respondents, and you're able to contact me on my phone number on 3833 3999, and also my email tim@fwo.net.au. And with today's webinar, I'll be uploading this onto the website, so if you need to revisit any of the areas that we've covered off, specifically from the taxation perspectives, you're more than welcome to do so. I'll take this time now to see if anyone's got any questions in regards to some of the areas that we've covered off. And with today's topic, I I just wanted to highlight some of the key areas whereby it's crucial to get the right planning. So essentially with business succession planning, no two businesses are identical, and a really tailored approach needs to be taken for each business with regards to the succession planning needs and their funding agreements in order to make sure there's a seamless process in the event something does happen to a business owner. So just having a look now to see if there's any questions. Doesn't seem to be any questions that have come through right now, but please feel free to email me directly, and I would like to thank you for all attending today's webinar. So thanks.